They called it the American dream, a home, a yard, stability, something you could pass down, and after the Great Depression, the federal government promised to help make that dream possible for millions of families. But for Black Americans, that promise came with fine print that quietly shut the door. In the 1930s, as the nation struggled to recover from economic collapse, the U.S. government created programs to stabilize housing and expand home ownership. Agencies like the Federal Housing Administration and the Homeowners Loan Corporation were designed to make mortgages affordable, protect banks, and help families buy homes instead of renting forever. On paper, these programs were race neutral. In practice, they were anything but. To decide which neighborhoods were safe for investment, government officials created color-coded maps of American cities. Green meant best, blue meant still desirable, yellow meant declining, and red, outlined boldly, meant hazardous. These red zones were not marked because of crime, housing quality, or infrastructure. They were marked for one reason: Black people lived there. This process became known as redlining, and once a neighborhood was marked red, banks refused to issue mortgages there, insurance companies denied coverage, and federal loan guarantees vanished. Even Black families with stable incomes, good credit, and steady jobs were blocked from buying homes simply because of where they lived or the color of their skin. At the same time, white families were being actively encouraged to buy homes in newly built suburbs. With government-backed loans, low interest rates, and long repayment terms, homeownership exploded. These homes appreciated in value, building equity that paid for college, funded businesses, and created generational wealth. Black families, meanwhile, were locked out, forced to rent, overcrowd, or buy homes through predatory contracts that stripped wealth instead of building it. This wasn't accidental. Federal housing manuals explicitly warned against insuring mortgages in areas with inharmonious racial groups. Developers were required to promise that homes would never be sold to Black buyers in order to receive federal backing. Entire suburbs were built with taxpayer support, and Black Americans were excluded by design. The impact compounded over decades. Homes became the single largest source of wealth for American families. Yet Black homeownership lagged far behind, not because of failure, but because of policy. By the time redlining was officially outlawed in 1968, the damage was already done. Neighborhoods had been starved of investment for a generation, and wealth gaps were locked in place. This was the third promise. First, land was promised and taken. Then savings were encouraged and lost. Now the American dream itself was offered, advertised, and systematically denied. And the consequences didn't end in the past. They shaped the cities, neighborhoods, and inequalities we still live with today. Redlining explains why some families inherit homes while others inherit rent. It explains why wealth grows quietly in some zip codes and disappears in others. And it explains how a promise can exist publicly while being withheld privately. This is part 3 of Promised Then Taken. And if you think this was the last time opportunity was blocked at the door, the next chapter makes it impossible to ignore.